The reverse repo facility at the Federal Reserve just hit over $2 trillion for the first time in history. So in this video, we are going to talk about number one, what is the reverse repo facility? Number two, how does it differ from the repo facility? Because they are opposite, they are different things. And then number three, what does this mean for you and the future of our economy? Ready? Let's dive in. All right, guys, so the reverse repo facility just hit over $2 trillion for the first time ever. Take a look with me at this chart. This is the Federal Reserve's reverse repo facility. You can see here that we just recently ticked up over that $2 trillion mark, currently sitting at $2,044 billion here. We'll zoom in a little bit more so that you can see. And you can see here that we ticked up over the weekend here. Now, historically, there's not much usage of this account. There was some usage of it in 2014 through 2017, really not much since then. And we can see that it was basically not used at all once COVID started until right here when in March of 2021, when it just started sucking in cash and never ever stopped, even until today. Now, I get asked many times where I get these charts from and how I find them, and I don't have a whole list of the charts that I use because I'm constantly kind of going through different charts, whichever ones are relevant at the time. But I want to give you guys a little bit of a hint. You can go to this website called Google, and you can type in reverse repo. And I always do this. I do FRED because FRED is the Federal Reserve Economic Data, F-R-E-D. And so that will, if you type in the word FRED there, that'll get you a list of Google results that you are most likely looking for. And the one that you want will probably pop up first. You can also go straight to their website and you can search for their data here. I just find that it's not typically as effective as using Google first. So what is the reverse repo facility and why does it have $2 trillion in it as of right now? Well, very, very simply, the reverse repo facility is excess cash in the financial system. That's it. There's a lot of cash in the financial system that has to go somewhere. Now, it can go into money market funds, it can go to buy treasuries, short-term government debt, it can do all sorts of things. Right now, $2 trillion worth of that cash is sitting in the reverse repo facility at the Federal Reserve. So understanding that it's excess cash in the financial system, where did it come from? Well, that's pretty simple to answer. In the fallout of March of 2020, they printed a ton of money, bought a bunch of government debt, then the government spent that money into the economy, that cash circulated through the system, and wound up as excess cash, excess bank deposits that wound up needing somewhere to go. So that's the first answer to the first question is, where did it come from? They basically printed and then spent it into existence. So why is it excess cash? Why does it need somewhere to go? That comes down to the rules on what banks are allowed to do with cash and what they need on the other side of their balance sheet. Because when you give your cash to a bank, that is not an asset for the bank, that's liability. It's a deposit that is redeemable on demand. You can go to the bank at any time and say, give me that cash. So on the balance sheet, it's a liability for the bank. So they need to offset it with an asset so they're not piled up with too many liabilities. So they're going to go out into the financial system and they're going to buy assets with the money. And so they're going to buy things like treasuries, short-term debt, but they did not have to do this during the first part of COVID. If you take a look with me at the reverse repo facility from when COVID started all the way through March of 2021, this reverse repo facility was not being used. That is because the supplementary leverage ratio was suspended. That means the Federal Reserve was not requiring banks to keep those capital requirements, those assets on the other side of their balance sheet from the liabilities, because the Fed knew, hey, you're going to get flooded with a lot of cash. We don't want anything crazy happening, so just take the cash. Don't worry about getting an asset on the other side. But that all changed in March of 2021. They said, okay, now you actually do have to go out and get an asset on the other side to offset that liability. So the third question is, why did that money then start going into the reverse repo facility instead of going out and buying regular assets, short-term debt? Well, the answer is rates were a little bit too low. There wasn't enough debt, and so money started to flood into that reverse repo facility to get the collateral that they needed instead of trying to find it on the open market. But what really changed the game was when the Federal Reserve changed the rate that they were paying in this facility from 0 to 0.05%. Take a look with me at this chart from the Federal Reserve that shows the rate that they're paying. In June of 2021, they increased the rate they were paying on this from 0 to 0.05. That started sucking in a ton of extra capital here and blew this account up to over $1.5 trillion. Now, this accomplished a few things. Number one, it kept short-term interest rates from going negative, because if all that cash, $1.5 trillion, would have gone out to the open market and bought short-term government debt as its collateral, that's too much money. There wasn't enough collateral to offset that, and the Federal Reserve was looking at how much the government was spending. If you take a look at this Treasury General account, this is the federal government's checking account, they started to spend this account down. This was a lot of money that they had pulled in from borrowing a ton when COVID hit, and then they started to spend it all down. So as they were spending this down, they weren't issuing new debt to spend all that money down. They were just spending what they had already borrowed. So while they were spending that money, they weren't also borrowing, which means there weren't new treasuries being created for all that new spending. So there's a ton of cash entering the system that the Federal Reserve said, hey, we need to make sure the financial system doesn't become overloaded with all this extra cash. We need it to absorb it. That's when they increased the rate here in June of 2021 to 0.05%, so that as the Federal Reserve here in June kept on spending this down, they knew that it wouldn't cause short-term rates to go negative, because they knew all that money would get sucked into here, because you're getting a risk-free 0.05%, better than anything with maturity risk, interest rate risk like short-term debt. Now, you might be looking at this little pop in rates here and thinking, well, why in the world would they do that? Take a look here as we zoom in. You can see that in March of this year, they increased the rate on the reverse repo facility from 0.05 to 0.3. Now, at that exact same time, the federal funds rate had gotten hiked for the first time recently. And so the federal funds rate is a range. They were targeting 0 to 25 basis points, 0.25%. So they raised interest rates to target the range of 0.25% to 0.5%, 0.25% to 0.5%. And so this reverse repo facility is always going to maintain 0.05% more than the federal funds rate. That is going to be 5 bips over the Fed funds rate. So the bottom end of the range of the Fed funds rate is 0.25%, the reverse repo facility 0.3%. And then it popped again in May here, because what happened in May? The Fed funds rate went up again to target the range of 0.75% to 1%. So the reverse repo facility is going to be 0.8%, which is again 0.05% higher than the Fed funds rate. All this time, the number one goal that the Federal Reserve is doing is making sure that this cash doesn't go out and flood the system and push short-term rates too far down, too far negative. And so we will continue to see this account suck in cash from the system until we get to the point where the Federal Reserve wants that cash to go back out into the system. That will happen at some point, but it's not going to happen yet. Now, in order to understand why, you have to understand the opposite side of the coin here, which is repo. We've been talking this whole time about reverse repo facility. Now we're going to talk about regular repo. And this whole time, keep in mind, repo means repurchase, doesn't mean repossess, like a car getting repossessed, something like that. This is a repurchase agreement. Back when Lehman blew up, that was a repo market crisis. When financial institutions get to the end of their day, they say, hey, I might have not enough cash, and so I'm going to go out to somebody else and I'm going to get some cash, and I'll give you some collateral, and I promise I'll repurchase it from you at a future point in time. Think a pawn shop, right? This is how financial institutions go from day to day. Other financial institutions will say, hey, we've got some extra cash, so we'll take that trade. We'll take that collateral from you, give you the cash, you repurchase that from us at a date in the future. Lehman blew up. All the collateral in the system was mortgage-backed securities, and everybody all at once realized, hey, these things are worthless, and so nobody wanted to take that collateral, but nobody had the cash, so everybody was about to fall over one by one by one. So that's when the Federal Reserve stepped in and took care of that. But that was a repo market crisis where the repo rate spiked because all the collateral was toxic. The repo rate also spiked in September of 2019. This time it wasn't because the collateral was bad, it's because there just wasn't enough cash. The collateral in the system, everybody had good collateral. It was all treasuries. It was just everybody was cash strapped. And so everybody went out to go get cash, but nobody had any to lend. And so the regular repo market rate spiked again. That's when the Federal Reserve stepped in and said, hey, we're going to provide funding into the repo market so that the repo market stays low. So it's all a balancing act between the collateral and the cash, the collateral and the cash. What's happening right now is an excess of cash that's flooding into the reverse repo facility. The Federal Reserve is providing collateral through that facility so that financial institutions have what they need. At some point here, it's going to flip, and there will be a scramble then for cash. Liquidity is getting sucked out of the system like crazy. $2 trillion in the reverse repo facility. We're seeing quantitative tightening, which is withdrawing liquidity from the system. It's pushing collateral into the system by the Federal Reserve selling it and taking cash out of the system in its place. We are seeing interest rates getting pushed up with the Fed funds rate going up and all other interest rates going up. That is withdrawing liquidity from the system as debt service costs rise, as debt gets paid off, as debt becomes more expensive, less debt gets taken on. We are seeing a reduction in liquidity everywhere we look. So at some point, things will flip. There will be a scramble for liquidity, a need for cash. And at that point, things will start to break. The Federal Reserve will press a button. This reverse repo facility has $2 trillion in it. They will take the reverse repo rate here from 0.8 to maybe 0.3, maybe 0.05, maybe back down to 0. And all of the cash that is in the reverse repo facility will be freed up because nobody will want to keep it in there anymore because you get a greater return by taking it out, getting some other collateral with it. All that cash will be freed up, will get sent and pushed back out into the system to deal with the liquidity crisis. That is the first point at which we will know there are signs of big trouble. We won't see the consequences of that trouble yet, but that is the point at which we will know somebody big is in trouble. Because the Federal Reserve is keeping $2 trillion of liquidity here so that at some point they can unleash it without having to stop QT, without having to stop raising rates, without having to lower rates. They've got $2 trillion in hiding, in secret, in waiting, so that when a big boy blows up because liquidity dried up too fast and they weren't ready for it, they weren't expecting it, the Federal Reserve can solve the problem without actually looking like they are reversing course. So the moment this account starts to drop very quickly and continuously, the moment the reverse repo rate goes down below what it's at right now, below the federal funds rate, below where it's been at historically, or down to 0. That is the moment that you know they are starting the bailout again. Bailout infinity will start one more time, and it's only a matter of time before that $2 trillion runs out. It'll give you some runway. It'll give the economy a little bit, one last kick here before they actually have to eat their words, lower interest rates again, and start up QE again. They'll have a $2 trillion runway before they have to get there, but that will be the first sign that things are about to reverse. So that is what the reverse repo facility means to you. And obviously, I'll let you know as soon as I notice a big change here, but for the time being, the Federal Reserve is still sucking liquidity out. They're keeping that $2 trillion. More and more cash will flood into that account until they change, and they will change at the first sign of internal trouble that nobody else will know about until much, much later. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.